And it's always good to have Tom Piotrowski with us over at CommSec for a look at the markets, which when we last spoke was going to be up 1.1% today. Tom Piotrowski, happy days. Is that still true?
Pete, your recollection is spot on. That's precisely what's the expectation this morning, a reflection of what was quite a constructive session for both US and European stocks. So I think, probably the more exciting aspect of things is what we saw in Europe. Mining stocks really got a move on where the European experience is concerned last night. Rio Tinto shares, for example, up by around 3.5%, Glencore up 2%. The latest pulse of optimism out of China is what drove that to an extent. The Chinese authorities cutting reserve requirement ratios for Chinese banks. It means that they've got more money to lend. So the latest initiative on the part of the Chinese to get the economy moving along. So the reason that you saw European stocks doing as well as they did was in a large part thanks to the gains for the mining stocks. So the Stock 600 index, the broader measure of European stock performance, up 1.5%. In the US, some better than expected retail sales numbers were quite important from the vantage point of the resilience of the consumer, Pete. So we had the S&P 500 up by around 0.8%, the Nasdaq up by about the same amount. So locally, energy stocks are going to be in focus as well. We've seen oil prices make new highs for the year. Whilst that's not welcome at a consumer level, that'll be quite supportive as far as the overall market is concerned today. Then on top of that, we'll have Chinese figures on a whole range of measures relating to how the Chinese economy is performing today. Fixed asset investment, retail sales, industrial production numbers, really quite important figures. Even in the context of what's been done to support the economy, it's kind of going to provide a bit of a benchmark perhaps from here to the end of the year in terms of improvement or not. So it's a big day really in that regard.
Okay, Tom Piotrowski, thank you.